2023 May paper, Money in Banking. So the first part is a compulsory, which is section A. So choose the best answer. Question number 1. One of the fundamental reasons for the existence of financial intermediation is that A, they engage in high-risk currency speculation. B, small and medium businesses are unable to raise capital through raising bonds and shares. C, deposits placed by retail customers are protected by government safety. D, they never take more risk with depositors' money than depositors would like them. So our answer would be B, because SME businesses cannot access capital markets directly. So we explain to say financial intermediaries like banks, they help to pool funds and allocate them where they're most needed. So SMEs here usually lack capital, lack access to capital markets due to information asymmetry and high transaction costs. So the financial intermediaries will be essential to availing these funds. Question number 2. A finance company lends 5,500 payable over 2 years in 2 annual installments of 2850. The yield to maturity will be given by. So we had done the formula. Remember the formula for yield to maturity? The yield to maturity formula.
Okay, I can barely hear you. Oh, your internet has become unstable.
Oh, sorry, I received a call.
Oh,
Okay, so remember the formula for yield to maturity? Okay, so this we have been given what? The following question. Can you hear me?
yes, clearly.
So we're given the following. I talked about yield to maturity in the previous uh, session. So we're given the following formula. A finance company lends out 5,500 loanable over 2 years, annual installments of 2850. The yield to maturity is approximately how much? Okay, so what is the formula for yield to maturity?
Oh, I can't remember it.
He had given you okay, so we say the yield to maturity is given by um, you can use interpolation method, or you can use the present value annuity method to find R. So you solve for R. So the present value annuity is equal to the amount plus 1 plus R plus uh, depending on the amounts of installments that you have. Okay, so we're going to use this formula here. Okay, so the P is a loan amount, and the A is the annual installment. So we have 2 years. So 1 plus R to the power 1 plus A 1 plus R to the power 2. So the annual payment is 2850. Then the loan amount is 5,500. So we're calculating for R. So when you calculate for R, you're going to find approximately 2.4%. Or we can use YTM formula is equal to coupon value plus the value of the bond and that's face value over N over 2 VB plus MV over 3. You can use any of these. But in this case, using interpolation, it will give us 2.4% if we're going to use that. So our answer would be A.
Collins, sorry to interrupt you. I thought for yield to maturity, there was also a formula that has something like the coupon multiplied by is it the present value,
Mm-hmm.
the IFA,
Mm-hmm.
minus the face value in brackets, the PVIF.
Yes.
Is that correct?
It has several formulas, so depending on what data has been given. So
Okay.
that is
No,
also
I think my question is more to, are we given tables for this, or would have, if we use this formula, would have to basically solve it without the tables?
you'll be given tables, but
Okay.
also the formulas. Let's see what formulas at the end here. I don't know what formulas. Whether you're given the formulas that I need to clarify. Okay, part three, an increase in market interest rate will reduce a bank's net worth in mark to market terms if A, the value of the rate sensitive assets exceeds the value of the rate sensitive liabilities. B, the average maturity of its fixed income assets exceeds the average maturity of the fixed income liabilities. C, if its equity is already low, and D, none of the above. So we're given our answer will be B. Okay, so the explanation is simply that when the interest rates will rise, longer duration assets lose more value than shorter duration liabilities. So this will reduce the net worth under the mark to market accounting. Okay, so question number 4. A young professional is proud that she reached her goal of being able to set aside funds monthly to buy essential durable household items. What function of money does this action best represent? Medium of exchange, store of value, unit of account, all of the above? So we talked about the functions of money. So which one is it?
I think it's all of the above.
Wait, can I look at it? I think it's store of value.
Professional strategy, reached a goal of being able to set aside funds monthly to buy essential durable households. Okay, you're right. Yeah, store value.
Store of value, yeah. Then which of the following are indirect instruments in monetary policy? So we talked about the direct and indirect. So required reserve ratio, sector loan restrictions, both A and B, none of the above. So we talked about the direct and indirect ways in which the monetary policy operates. So which ones are the indirect ones?
Okay, so by elimination, I'll remove B.
Mm,
And if I'm removing B, that means I can remove C, which
okay.
leaves me with A. I'll go with A. Required reserve ratio.
But not B. Which one of the following are direct instruments of the monetary policy? C.
Indirect.
Indirect, yes, indirect. Okay,
Uh-huh.
so
So based on the notes we're looking at earlier, we had sectorial loan restrictions under direct.
mhm.
So that's why I'm eliminating it, which means I can eliminate C as well because C includes A and B.
So on the indirect, we talked about the OMO systems, the policy
Yeah.
rates, the required reserve ratio, the interest
Mm.
rate.
Mm.
Okay. On the direct, we
So
have
mhm.
credit rationing. We talked about administrative interest rate, sectoral credit controls, and credit ceilings. Those are direct ones. So under indirect, we have the required
Okay.
reserve ratio. So our answer will therefore be because um, which ones are indirect? So
Mhm.
where does sectoral loan restrictions fall under?
Doesn't that fall under the direct?
Yes, falls under the direct. Yeah, you're right. This one
So
for so
it would be
many.
A.
So which one is indirect? So it should be A. Yeah, you're right. A. Okay. All right. Which of the following is a step that the central bank would take to encourage greater investment in the economy? It will look at increasing the cash reserve ratio. It will look at reducing the cash reserve ratio. It will look at increasing the bank rate. It will look at selling government securities in the open market. So in which way will the bank encourage greater investment in the economy?
I think I would go for B.
Okay, B, yes, encourage. So B, why? Because lowering cash reserve ratio will give banks more money to lend, which will encourage what? Investment in the economy. Excellent. Okay, then we go to question number um, 5. The three C's of credit are character, capital, charity, character, capacity, charity, character, capital, essential character, capacity, capital. Which one is it?
D.
That says what?
Uh, D is
D.
character, capacity, and capital.
Yes, D. So we explain what each of these ones are. Then number identify the formula for capital adequacy ratio. Tier 1 plus Tier 2 over risk-weighted assets. Risk-weighted assets over Tier 1 plus Tier 2. Tier 1 plus Tier 2 plus Tier 1 plus risk. So which one is it? I think we looked at this formula.
A. Yeah.
Mm-hmm. What's the answer? A. Yeah.
A.
All right. Then number 9. What is the total payout of if an individual invests 10,000 at 5% in 5 years' time? Okay. So what's the future value?
What is the total payout? If
Present
any,
value plus
then one,
1 plus
one, R
the power,
to the N.
power time, right? There's no compounding in there. So it's 10,000, 1.05 to the power 5. Okay, we have a calculator there.
Yes.
I don't have a calculator, so you can help.
That would be 12,762.
Okay, so the closest is what? 824.
10,000 times 1.05 to the power 5.
Mhm.
Okay.
So C, yeah?
Say C, yeah.
Okay. Then what is the risk weight for personal loans? So risk weight for personal loans is usually 100%. Because personal loans are typically unsecured, so they carry 100% risk. Okay.
So when banks say you can get a secured loan, or where they do deductions from your directly from your salary,
Mhm.
are those still unsecured?
No, those ones are secured because you have security backed up.
Okay.
But here we're looking at a normal, ordinary person. That's a very good question. Mm, okay. And also, we're looking at a person who's not in government because the assumption that it's 100% some institutions can default, may not pay on time. Okay, so a business that gathers credit information on all borrowers in a particular region for the purpose of selling that information is called what?
Credit bureau.
Yes, credit bureau. Okay, for the credit bureau. So number 12. When interest rate is lower than equilibrium rate of borrowing funds, then the financial system is surplus, deficit, short-term, long-term funds. So when interest rate is lower than equilibrium rate of borrowing of funds, then the financial system has surplus, deficit, long-term, short-term funds. So it means we have a deficit. So a deficit exists when the interest rate is below the equilibrium level. Okay, the opposite is a surplus. So below the equilibrium interest rate will create excess demand over supply. So this will result in a deficit in loanable funds. Okay, number 13. Which of the following will most likely result in lower real interest rate in a nation? A nation that provides an investment tax credit to new businesses. The citizens of the nation increase their savings for retirement. The nation is experiencing political instability and economic risk. The nation's government increases its borrowing to finance spending in capital projects. So answer will be B. Okay. What happens when the citizens increase their savings? So the real interest rate will fall. So this is because increased savings will increase the supply for loanable funds. So when people save, they're going to increase supply for their funds available to use. So this will put a downward pressure on the real interest rates. Okay. So I discussed how the curves move. Then number 14, which of the following will shift the supply of loanable funds to the left? A decrease in disposable income, a decrease in inflation rate, a decrease in interest rates paid to private bank deposits, an increase in government deficit spending. Okay, so if loanable funds income drops, what happens to supply for loanable funds? So the answer is the supply for loanable funds will shift to the left, A. So I explained that to say when you have less disposable income, what does it mean? Means people will save less. So this will reduce the supply of the donable funds market. That's why the supply will shift to the left, right? When it shifts to the right, meaning there will be more available disposable income for people who use money. So there are behaviors that happen in the economy where um, institutions will behave in a certain way, okay? Based on the theory, speculatively. So we go to question number 15. A breakdown in the financial markets can result in rapid economic growth, political and social instability, financial stability, stable prices. So I talked about this. You can try this one. Breakdown
Yeah.
in
Okay.
financial markets. Yes, B, social and political instability. So when there's a falling financial system, it disrupts access to capital, to savings. This will result to social unrest and political fallout. Okay, so number 16, which of the following is traded in the money market? Which of the following is traded in the money market? Commercial paper, bonds, bank loans, none of the above.
Commercial papers.
Yes, commercial paper. All right. What is wrong with bonds?
The much longer term.
Yes. And bank loan?
Bank loans are they an investment?
And both. They can be long term or short term, so it's unpredictable. So the best is commercial paper. Okay. The term structure of interest is relationship between interest rates and all securities, interest rate on a security and the time to maturity, relationship on the yield on a bond and default rate, or of the above are correct.
I would go for B.
Yes, B, relationship between interest rates and term to maturity. Yes. The term structure or the yield curve actually shows the interest rates differ based on how long until the bond matures. All right, so what is an inverted hybrid curve? What is an inverted hybrid? It implies that A, long-term interest rates are lower than short-term interest rate. Long-term interest rates are higher than short-term interest rates. Long-term interest rates are the same as short-term interest rates. The immediate interest rates are higher than either short-term or long-term interest rates.
I struggle with these curves, huh? I haven't yet fully understood them such that I can easily explain.
The answer is A. Okay. So an inverted yield curve is a downward sloping yield curve. So an inverted yield curve actually happens when the long-term interest rates are lower than the short-term rates. This will usually signal a recession, as I explained, signals a recession. Okay, number 19. Which of the theories does not explain the term structure, the yield curve? Liquidity, expectations, Keynesian, and segmentation theory. Which one doesn't explain the term structure of the yield curve? So it is a Keynesian theory. This one only is used in macroeconomics to look at interest, to look at behavior. It doesn't look at interest rates. The other two, we talked about them, they do. Okay, then I had ended on the money multiplier. I think I didn't give you the formula. So assuming excess reserve is 5%, statutory reserve is 10%, and currency circulation is 5%, calculate the money multiplier. Okay, my multiplier is given by 1 divided by the reserve ratio plus the um, 1 over reserve ratio plus the currency in circulation, say R plus excess reserve ratio. This is 1 over the 5% plus the 10% plus the 5%. Or divide that. What do we get?
1 second, please. That's 10%, huh? That's
Yes.
10%.
Yes. What would be 5 exactly? So because this is a 1, 3.
That'll be 5.
Mhm. Right. So we
Okay. EER, okay.
so 1 over reserve ratio plus price in circulation plus the ex excess
Six.
reserve ratio. So 1 over 20, which is 0.1 over 0.2, which is 5. So multiply it 5 times. Okay. Is it clear?
Yes, it is.
So we see how it was important to go through some recap.
Mhm.
Okay. So now we can continue. True or false? Individuals have an advantage over the financial institutions in that they can easily diversify away from credit risk of their asset portfolio. So each mark is carrying about 4 marks. True or false? So individuals have an advantage over financial institutions in that they can, in that they can more easily
More.
diversify away credit risk of their asset portfolio. Is that true or false? That's true. The financial systems help mobilize savings and by offering what? The safe and liquid instrument. This which will help them channel them into investments. So that is true.
Okay.
Then how many questions are here? This is to here. Did I explain the LM schedules?
No.
Okay. So let me do this.